Hello and welcome to this CII session on captive insurance companies. My name is Paul Eaton and I'm the new Business Director for Heritage Insurance Management. We are a company based in Guernsey, Malta and Gibraltar who specialise in the creation and management of both captive and commercial insurance companies. This session is about captive insurance companies, which I will refer to as captives, and will be delivered in two sections. Section 1 is an introduction to the world of captives and will run through the basic concept. Section 2, which will be presented by my colleague Martin Pelley, will consider the current key issues for users of captives. Many of us working in the insurance industry have or will come into contact with captives, and my experience is that there is often some mystery about what they are, how they work, and what they are being used for. The purpose of today's session is to unravel any mystery by giving you some knowledge to help you understand the basic principles. In this first section, we will talk about what captives are, how they are used for self-insurance and risk financing, why clients use captives, different types of captive entity, including protected cells, and how, on a practical level, captives participate in insurance programs. So let's start off with what is a captive. Captive insurance companies have been used for many years by organisations as one means of helping them manage their retained risk exposures. Typically, that part of their insurance programme which they want to self-insure, often a large excess or deductible. There are many definitions of captives, but the one I like the best is: a captive is a special purpose insurance or reinsurance company established primarily to finance risks arising from its parent group or groups and thereby contributing to a reduction in that parent's total cost of risk. In other words, a captive is an insurance or sometimes reinsurance company which has been formed by a parent company to underwrite a proportion of the parent's insurance programme. It is important to understand that a captive is a bona fide insurance company. It accepts real insurable risk from its parent or sponsor. Captives are used extensively throughout the world by both major and medium-sized corporations to cover risks situated at home and abroad. As trade barriers throughout the world have been lowered and companies have become more internationally orientated, insurance buyers are taking a more global approach to risk financing, and captives can play an integral role in the successful implementation of a global risk financing strategy. All captives are licensed and regulated as insurance or reinsurance companies, and, in terms of location, most tend to be domiciled in offshore financial centres like Guernsey or Bermuda. This is an area that Martin will cover in more detail later in the session. Captives require the parent to subscribe capital into the company in order to meet the solvency required by the insurance law, and they are regulated accordingly by the Financial Services Commission in the domicile where the company is incorporated. The level of capital required can vary between domiciles, and again, this is something Martin will cover later. Captives are formed for many reasons, including taking greater control over the insurance purchase, a means of escaping from some of the unpredictability of the commercial insurance market, which has historically been cyclical. Pricing, cover, deductibles and capacity can change through the market cycle, from being in plentiful supply when the market is soft to being in short supply when the market is hard. By establishing a captive to underwrite those risks which the parent has chosen to retain, there is an opportunity for that parent to change its relationship with the commercial insurance market and move to a position where only larger and less frequent losses are covered. This brings a number of benefits. Firstly, there is the opportunity to price those risks retained based solely upon the performance of the parent's business. And since this is now retained risk, the subsequent opportunity to improve that performance using risk management controls. The process of pound swapping with insurers where underwriters need to include a provision in their annual premium for predictable claims, is also avoided. The relationship with the commercial market can be improved, as there is less adversarial discussion around small claims and the focus shifts to risk management. This helps to foster longer-term relationships and produces more stable pricing, cover and capacity. More control can be developed by the parent over the insurance purchase, as the captive can be used to vary the self-insured retention depending on the commercial market position. Typically, captives are used to best effect by their parent as a tool during the negotiating process with underwriters at renewal time and can be used to counteract, for instance, the effect of a rating increase. There is also the opportunity for increased revenue, a chance for the captive's parent to capture a share of the underwriting profits and investment income that would otherwise be earned by the commercial underwriter. Finally, captives offer a means to access the reinsurance market, or, in certain circumstances, as a means of diversifying into insurance services. Captives are usually designed to participate in self-insurance structures, insuring the risks of the parent. We call these pure captives, and most of these companies are used to provide benefit and value to the parent by helping to stabilise and minimise the longer-term cost of risk. There are also commercial or third-party captives, which are formed to underwrite associated business of the parent, typically profitable insurance lines, with the objective of creating underwriting profits. In this session, we will focus on pure captives, but it is important to recognise the trend of captives underwriting either a mix of self-insurance and commercial insurance, or exclusively commercial insurance. These types of captive use the underwriting profits generated to increase the parent's revenue or to help subsidise self-insurance premiums. Summarising, the main advantages of using a captive are to allow the ability to price risks appropriately, reflecting the loss record of the company in question, helping companies achieve more stable premium rates in comparison to the unpredictable swings typical of the commercial insurance market. The promotion of risk awareness and control is achieved as the losses paid by the captive tend to be highly visible to senior representatives of the parent company. The potential for bespoke cover and wordings is available, and on occasions the ability to provide cover for risks which are unavailable or inappropriately priced in the commercial insurance market. Captives provide extra negotiating power with underwriters and can act as a means to gain access to the reinsurance market. They also offer the benefit of retaining investment income and cash flow. Whilst there are many potential benefits in forming a captive, there are some potential disadvantages which need to be considered before a decision to establish a captive is taken. The main considerations are capital. The parent must contribute the requisite capital to support the captive's underwriting. There can be the risk of adverse results, which could erode the captive's capital. However, most captives do tend to adopt a fairly cautious approach, particularly in their formative years, and limit the underwriting downside by the use of aggregate limits and reinsurance. Operating costs also need to be taken into account, the annual expenses necessary to run the captive. Before looking at an example, it is worth briefly considering where captives can best participate in their parents' insurance programme to add most value. Of course, this will vary between companies, so it makes sense to consider this in terms of a risk frequency and severity model. Losses in the red area are both infrequent and large, and for most captives, it does not make sense for a participation in this risk area, as a substantial capital would be needed, and usually the commercial insurance market has good appetite for this type of risk. Losses in the green area are those that happen regularly, but which are very small. A good example would be accidental damage to goods in a retailer. It makes sense that these losses, which are very predictable and small in value, are retained by the company, usually by way of a policy excess. Captives can be used to cover losses in this area, particularly if the parent is interested in monitoring the performance of risk management. But more often, it is decided that the best approach is for individual business units to manage these smaller incidents. Those risks in the middle amber area are those which happen with moderate frequency and also moderate severity. This is the area of risk which is most commonly insured by captives, as often the commercial insurance market is more expensive compared to retaining the risk, and this affords the opportunity for the company to retain the risk and to risk finance this into their captive. I mentioned before that captives can either act as insurers or reinsurers. Often, this is determined by the structure of the insurance program that the captive needs to fit into, and there needs to be consideration of a number of factors. For instance, from a regulatory and legal perspective, is the captive able to underwrite insurance directly in the territories required? For instance, a Guernsey domiciled captive can underwrite policies directly into the UK, apart from compulsory covers, but could not underwrite policies directly into France or Germany. However, a Malta or Gibraltar domiciled captive can underwrite directly into any of the European states. Also, is local service necessary? Some insurance programs require that operating companies have locally issued policies, premium collection, and local claims management. In this first structure, the insurance program is being underwritten by one or a number of local insurers who are providing fronting services to the captive. The captive is acting as a reinsurer to those local insurers and may be either accepting all of the insurance risk or just the proportion that it is comfortable to retain. Most captives do not have the capacity nor appetite to cover the entire insurance program, and therefore, if this captive was being ceded all of the original risk, then it would probably use reinsurance to reduce the risk exposure to the level at which it is comfortable. Whilst this type of program has the advantage of local insurers and service, it is likely that the insurers will charge a fee to the captive for the insurance risk they are fronting on its behalf. In the second structure, the captive is being used to directly issue insurance policies into Australia, Belgium, and the UK. Again, this captive is using reinsurance to reduce the risk exposure. This approach has the benefit of maximum flexibility whilst keeping costs low. There are no fronting charges to pay, and the captive can issue the exact scope of cover that is required. Additionally, the captive has the widest possible choice of insurers or reinsurers with whom to place their reinsurance protection. Let's now consider an example that shows how a captive can be used. The company in question is a firm of accountants, and the major insurance purchase is a professional indemnity or PI program. This firm is a medium-sized partnership and purchases total PI cover of £20 million, which is placed by its insurance brokers at an annual cost of £800,000. The cover is placed in layers: a primary £5 million layer, priced at £600,000, a £5 million excessive £5 million layer, priced at £125,000, and the top £10 million excess £10 million layer, priced at £75,000. The firm has enjoyed a good claims experience over the years, but in the last period of cover had a claim paid for £1.25 million, and as a result, at renewal, the premium on the primary layer is being quoted at £850,000, an increase of £250,000. The firm considers this loss to have been a one-off event and believes it has good risk management in place. There is appetite to accept risk, and with a view of self-insuring the first £1 million, the firm instructs their insurance broker to investigate the potential market placement for a £4 million excess £1 million layer to replace the primary £5 million layer. The insurance market is much more competitive on this revised layer and quotes a premium of £250,000, which is accepted. The firm decides to establish a captive to underwrite and risk finance the £1 million deductible that they have decided to retain. As the firm operates only in the UK, they decide that Guernsey is a suitable domicile, as the policy can be issued directly to them without the need for a fronting insurer. Within 8 weeks, they incorporate their captive insurance company, which issues the required cover to the firm. The captive charges a premium of £350,000 to the firm, which is based upon the expiring total price of the primary £5 million layer, now split between the commercial insurance market and the captive. The captive issues share capital of £650,000 to the parent, which is partly paid at £100,000 with £550,000 unpaid. The figure of £650,000 is chosen so that the captive has sufficient share capital to be able to meet its maximum liability of £1 million in the event of a total loss under the policy. The shares are partly paid at £100,000 in order for the captive to meet the required solvency, but whilst not overburdening the firm to pay the full £650,000, unless, of course, there is a large loss. This provides the firm with a financially efficient solution and the following advantages. Firstly, the potential for underwriting profit. Should the policy run claims-free, then the captive will produce an underwriting profit of £350,000, which can be used to pay a dividend to the firm, or to accept a greater level of risk for the following period, or it could be used to finance the underwriting of additional lines of insurance for the firm, should that be required. Secondly, there is no fronting insurer required, which keeps the operating costs low. Over time, the premium for this risk retention can be geared to the actual loss experience, which provides the parent with a highly efficient mechanism. Other benefits include investment income on premiums and reserves, greater control over claims, and influence over the policy coverage. Before handing over to Martin, I'd like to talk a little about protected cell companies, or PCCs. The PCC concept originated in Guernsey and was introduced under specific legislation in 1997. Similar facilities are now available in a number of other offshore insurance domiciles. A PCC is a single legal entity made up of a core and any number of cells. The cells are separate and distinct from each other, and most importantly, the assets and liabilities of each cell are legally segregated from all other cells and the core of the PCC. This means that a creditor of any one cell can only access the assets of that particular cell, and this allows a PCC to support the insurance underwriting activities of many clients. Cells within a PCC offer similar advantages to those of captive insurance companies because, with respect to its underwriting activities, a cell behaves in the same way as a wholly owned captive insurance company. Effectively, a PCC cell is a mini captive, and they have become a very popular low-cost alternative to captives as they can provide a number of additional benefits, such as there is no minimum capital requirement, as the PCC has already been capitalised by its owner to the minimum statutory level. They are quicker to form and to terminate. Also, the operating expenses and start-up costs are lower. And finally, there is less call on management time due to there being no requirement for a cell to hold board meetings. That's the end of the first section, which I hope you found useful. I'll now hand over to Martin.
Hello, I'm Martin Pelley. I'm the Compliance Director for Heritage Insurance Management in Guernsey. Before joining Heritage, I worked for the Insurance Regulator, the Guernsey Financial Services Commission. I'm a Chartered Accountant by qualification and worked for PricewaterhouseCoopers in London for 10 years before returning to Guernsey. Paul mentioned that the decision about where and whether to have a captive is influenced by a number of factors. Once the decision to form a captive has been made and the legal structure of the captive has been determined, there are some further key considerations, including the choice of jurisdiction or domicile of the captive, the legislative environment applicable to it, and the regulatory regime applying to it. Of course, these three are interconnected because the regulations and legislation will vary by jurisdiction. There are jurisdictions or domiciles in the world which are more popular for captive insurance than others. The largest domiciles for captive insurance include Bermuda, the US state of Vermont, the Cayman Islands, and Guernsey, although captive insurers can be created anywhere that has insurance legislation. The reason for these places becoming captive domiciles has much more to do with their insurance laws than it does with their popularity as holiday destinations, although it is crucial that they have excellent transport links, as ease of physical access is an important factor in the decision about where to domicile a captive. Bermuda and the Cayman Islands have historically been popular jurisdictions for captive insurers owned by US companies, as their insurance laws have included specific solvency and other provisions for captives, as well as being easily accessible from the USA. More recently, a number of US states have enacted captive insurance legislation which has replicated the legislative and regulatory advantages of Bermuda and the Caymans, such that a number of captives have been moved or migrated from Bermuda and the Caymans to places like Vermont. Vermont was the first US state to enact captive legislation, but now over half the states have enacted captive legislation. Of course, having your captive domiciled in your home state, or at least on the mainland US, makes accessing it even easier than Bermuda. In Europe, Guernsey is the largest captive domicile, with around 700 licensed insurers. The reason for Guernsey's attractiveness as a captive domicile is that it also has insurance legislation and regulations which, like Bermuda, are more suited to captive insurance than other parts of Europe. Also, Guernsey is less than an hour's flight from London, one of the world's most important insurance centres. When selecting a domicile, another important consideration alongside the ease of access and the insurance legislation is the receptiveness of the regulator. In Guernsey, just as in other key captive domiciles, the regulator is geared up to license captive insurance in a matter of weeks rather than months, as would be the case in some other jurisdictions. This is important as captives usually take a proportion of their parents' risk alongside other insurers, so they must be up and running in good time to fit in with the parent company's insurance renewal period. I'll discuss this later on. Just as Bermuda and the Caymans are independent of the USA, so too in Europe are jurisdictions like Guernsey and the Isle of Man independent and outside of the European Union, which means that they do not need to adopt EU directives governing insurance companies. This gives them a certain competitive advantage in relation to captives, as unlike US states, EU member states cannot implement captive legislation which does not conform with EU insurance laws. On the other hand, Guernsey and the Isle of Man are restricted in their ability to directly insure some European risks. This is because they cannot take advantage of the EU freedom of services legislation. For this reason, some captives choose to be located in EU domiciles such as Luxembourg, Malta and Gibraltar. For EU domiciles, the freedom of services legislation means that captive insurers can directly insure to all other EU member states, although they will be subject to all the EU directives, including those relating to capital and regulatory requirements for insurers. Another advantage of places like Guernsey, Luxembourg, Malta and the Isle of Man as captive jurisdictions is that there are many specialist insurance management firms located in these jurisdictions who have the knowledge and experience of setting up and managing captive insurers. Their presence helps to ensure that the cost of setting up a captive remains competitively priced, as well as providing the captive owner with a choice of service provider to enable them to choose an insurance manager which is best able to provide the tailored service they require. New and emerging domiciles for captive insurance would include some Middle Eastern jurisdictions such as Dubai, Bahrain and Qatar, all of which have developed excellent international transport links and are looking to diversify their economy and attract both Western and Asian businesses wishing to form captives. Whilst these domiciles have enacted captive legislation, their markets are still very much developing and perhaps lack some of the expertise of the mature domiciles like Bermuda and Guernsey. Turning to the legislation governing captive insurance, one of the main areas of focus is in relation to the capital and solvency requirements for captives. As captives are risk retention tools for their parent companies, the risk profile of a captive is different to an insurer writing third-party risks, in that the policyholder is the owner of the company and should have a good knowledge of the risk profile of the business being written by the captive. For this reason, some captive jurisdictions, like Guernsey, Bermuda and the Isle of Man, impose a lower capital requirement on captive insurers than would be the case for commercial insurers. However, the legislation in place in the jurisdiction must be explicit as to the capital and solvency requirements. For instance, in both Guernsey and the Isle of Man, the minimum capital requirement for a captive insurance company is £100,000, and the minimum solvency requirement is 18% of the net earned premiums, being net of reinsurance and commissions, which will be written in the first 12 months. This means that an insurer which is expecting to write £5 million of net premiums must hold at least £900,000 of capital in order to meet the legislative requirements. The legislation will also govern how this capital is to be held. It may not necessarily be required to be held in cash, as certain other assets, such as government bonds or letters of credit, will also qualify as approved assets. In comparison, the EU capital requirements for insurers require a minimum capital of €2.5 million, increasing to €3.7 million if writing liability business. The minimum solvency requirement in the EU is 18% of the gross earned premium in the first 12 months, increasing to 27% for liability business. Most EU regulators apply a buffer to these requirements, meaning that the solvency requirement for a new insurer can be between 27% and 36% of gross premiums. These capital requirements apply to all general insurers, regardless of whether they're captives or not. If we take an insurer writing a £25 million gross premium with a £20 million outwards reinsurance, giving a net premium of £5 million, it can be seen that the legislative requirements within the EU of £6.75 million are much more demanding than the £900,000 required by non-EU domiciles. However, it may be the case that certain captives, which are large enough, are happy to hold more capital in order to be able to insure EU-based risks directly through the Freedom of Services legislation. The EU capital requirements are being amended currently to make them more risk-based. The EU directive known as Solvency II is amending the EU legislation to require insurers to carry a capital requirement which is linked to its risk profile. As captives have a lower risk profile, this would logically seem to be advantageous for captives. However, the factors within the computation do not adequately cater for the lower risks carried by captives, and the absolute minimum capital requirement of €2.5 million will remain. Certain trade associations, such as the European Captive Insurers and Reinsurers Owners Association, or ECIROA, are lobbying the European Commission to try to ensure that captives are treated fairly under this regime. Since Guernsey and the Isle of Man are not in the EU, they will not be subject to Solvency II, but they will need to implement some form of risk-based capital requirement in order to comply with the international best practice. Nevertheless, these jurisdictions are much better placed to implement a captive-appropriate risk-based solvency regime, which will mean that they will be attractive as captive domiciles. In addition to solvency requirements, other legislation which will impact on captives include the availability of protected cell company legislation. Both Guernsey and the Isle of Man have PCC legislation enabling the creation of cells as captives and providing for the statutory segregation of assets and liabilities between cells. Within the European Union, both Malta and Gibraltar have PCC legislation. However, no other EU jurisdictions have PCC legislation, which means that all captive insurers in, for instance, Luxembourg or Ireland must be traditional companies. The advantage of a cell over a company is that it can be more cost-effective to run and can be easier to establish, as the cell will form part of a pre-existing licensed insurer. Other important legislation in relation to captive insurance is the availability of migration provisions within the law to enable the efficient movement of captive insurance companies from one jurisdiction to another. Most captive domiciles have migration provisions in their law, making it relatively straightforward to move a captive insurer from one jurisdiction to the other. Captives can be moved for a variety of reasons, including moving them closer to their parent company, moving them into or out of the EU, or else moving them to take advantage of specific capital or regulatory provisions in the particular domicile. Most captive domiciles will also have provisions in their law for the conversion of companies into PCC companies or cells, amalgamation provisions to allow the easy consolidation or merging of captives. Whilst a low tax environment is helpful, it is not usually a deciding factor in the location of a captive, as high tax jurisdictions like the UK have controlled foreign company legislation, which means that it is not possible for the parent companies of captives to avoid tax on profits generated by foreign subsidiaries or cells, including their captives. In any case, the use of captives to specifically avoid tax is at best morally questionable and at worst illegal, such that it would be unlikely to obtain regulatory approval. Turning now to the regulatory environment, this is a very important factor which companies need to examine when considering the location of their captive. Most companies which are large enough to have a captive will be successful, highly reputable international companies which have a well-developed and sensitive risk management function. As such, they are mindful of the importance of locating subsidiaries in jurisdictions which have a track record for being reputable and with a high-quality regulatory regime. Let's take a look at Guernsey's regulator, the Guernsey Financial Services Commission. The GFSC has been the regulator for insurance business since its formation in 1987. The GFSC is an active member of the International Association of Insurance Supervisors, which is the international standard-setting body for insurance, and was one of the founding members of the IIS. Furthermore, the Guernsey insurance regulations have been continuously updated to ensure that they remain fully compliant with the IIS core principles. It is these principles which are used by organisations such as the OECD and the IMF in their assessments of the financial stability and robustness of financial centres. As a consequence, being fully compliant with the IIS core principles means that Guernsey is able to receive a favourable report from all such international bodies who review it. However, an effective regulator must do more than just meet international best practice. They must be responsive to industry and facilitate the introduction of new business, which in the case of captive insurance can be quite time sensitive. In other words, a successful captive domicile will be able to review an application for and license a new captive insurance company or cell in a matter of weeks rather than months. But the speed at which they operate should not compromise the quality and robustness of their supervisory oversight. One way in which captive regulators are able to license captives more quickly than some other insurance regulators is by also regulating the insurance manager to whom the captive outsources their day-to-day management. By regulating the service provider, the regulator will gain a significant level of comfort in relation to new captives which are proposed to be managed by the regulated manager. Most captive domiciles do regulate insurance managers for this reason, but not all jurisdictions. For instance, Ireland doesn't. Consequently, those which do not may be at a disadvantage in terms of the speed at which captive licenses can be issued, as well as the robustness of the insurance management oversight. That's the end of the second session. Paul and I hope you found this session on captives very useful. Thank you for listening.